What if I told you that silver has not even started its real move yet? What if the powerful rally you are seeing right now is only the warm-up phase and the real acceleration is still ahead? Most investors look at a strong price spike and immediately think, that's it, the top is in. But history shows that silver does not behave like most assets. When it moves, it does not move slowly. It explodes. Welcome to Gold Silver Scope. Today, we are going to break down silver using long-term historical patterns, weekly all-time highs, and structural bull market behavior. Not hype, not emotion, just patterns, math, and probability. Let's start with the bigger picture. Silver has had two major historical peaks over the past 50 years. One was in 1980 when it surged toward $50. The second was in 2011 when it again approached that same level. For decades, silver struggled to break meaningfully above that historical ceiling. It experienced deep drawdowns. At one point in the early 1990s, silver was more than 90% below its previous all-time high. That kind of collapse is extreme. This is one of the key differences between gold and silver. Silver is far more volatile. When it falls hard. But when it rises aggressively. Its percentage swings are much larger. Now fast forward to the present cycle. For the first time in many years, silver is forming a fresh cluster of weekly all-time highs. That is extremely important. In 2011, even though price ran strongly, it did not create sustained weekly all-time highs on a structural basis. That tells us something. It suggests that the previous cycle may not have been a full breakout phase. It may have been a strong rally inside a longer consolidation period. But now, we are seeing something different. When you track how many weekly all-time highs occur within rolling 26-week and 52-week windows, you begin to see patterns. In the 1970s bull market, silver did not just spike once. It formed clusters. There were waves of new highs grouped together, then a pause, then another cluster, even stronger than the first. That is how major silver bull markets behave. They build momentum in stages. In the early 1970s, silver created a cluster of consecutive weekly all-time highs. Then later in the decade, it formed an even larger cluster. Each cluster lasted longer and produced stronger percentage gains than the previous one. The final year of that bull market delivered the most dramatic move of all. After 1980, there were no meaningful clusters of weekly all-time highs for decades, not even during the 2011 rally. That is very significant. It means the current breakout behavior is rare. It does not happen often in silver's history. And when rare structural patterns appear, serious investors pay attention. Many people today are worried that silver's recent parabolic move means the rally is over. That is a natural emotional reaction. When price rises quickly, fear of a correction increases. And yes, pullbacks are normal. Silver always corrects along the way. But corrections inside a bull market are not the same as the end of a bull market. The presence of fresh clusters of weekly all-time highs suggests momentum is building, not fading. Historically, the first cluster in a silver bull market was not the last. It was the beginning of acceleration. Later clusters became longer and steeper. Gains expanded. Volatility increased. Attention from mainstream investors grew rapidly. Right now, silver is forming what looks like an early-stage cluster. It has produced several consecutive weekly all-time highs. The percentage gain during this cluster is strong, but not extreme by historical standards. In past cycles, later clusters delivered much larger percentage increases. This is where long-term perspective becomes powerful. If you zoom out and compare today's 9-year buildup before the breakout with the buildup before 1980, the structures look surprisingly similar. In the late 1970s, silver spent years gradually rising before entering its explosive final phase. At the beginning of 1979, silver was trading around $6. Few people believed it could go dramatically higher. The idea of an 8x move in 1 year sounded absurd. And yet that is exactly what happened. From roughly $6 to nearly $50 in about 12 months. Almost 700% in 1 year. At the time, that prediction would have sounded crazy. Today, when people hear projections of silver reaching several $100s in a future cycle, they react the same way. It sounds impossible. It sounds unrealistic. But history reminds us that silver has already done something similar before. Now, does that mean it will repeat exactly? No. Markets never repeat perfectly, but they often rhyme. Human psychology, supply-demand imbalances, and momentum cycles tend to follow recognizable patterns. So let's consider 3 possible scenarios. First scenario, the bull market is over. Based on historical cluster behavior and long-term monetary conditions, that argument looks weak. Structural demand drivers are still present. We are seeing fresh breakouts, not exhaustion patterns. Second scenario, the bull market continues for many years. In this case, price appreciation may be strong but more gradual, stretched over time. Third scenario, we are in the early phase of a powerful acceleration that could last 1 to 2 years before reaching a major peak. Historically, when silver formed clusters of consecutive weekly all-time highs, they often occurred within relatively tight time windows. In the late 1970s, the final explosive phase lasted roughly 1 year. During that time, price multiplied dramatically. If we apply that framework to today, the math becomes interesting. Even a fraction of a historical percentage move would imply much higher prices than most investors are currently prepared for. But here is the key. This is not about prediction certainty. It is about probability and structure. Silver's behavior is telling us that something has shifted. Decades without sustained weekly all-time highs are now followed by new clusters forming. That is not normal background noise. That is structural change. And when silver shifts from long dormancy into breakout mode, history suggests we are not witnessing the end. We may be witnessing the beginning of something much larger. Now let's explore the middle ground scenario, because this is where things become truly fascinating. Many investors think in extremes. Either the bull market is finished, or it will last another 10 years. But what if we are in a powerful acceleration phase that still has meaningful upside left, even if the total cycle duration is shorter than expected? To understand this, we need to go back to 1979. At the start of that year, silver was trading near $6 per ounce. After nearly a decade of gradual buildup since the early 1970s, price had already multiplied several times from its base near $1. To many investors back then, silver already looked expensive. It had already moved significantly. The idea that it could rise another 700% in a single year seemed unrealistic. And yet, from January 1979 to January 1980, silver surged from roughly $6 to nearly $50. That was almost an 8-fold increase in about 12 months. It was not a slow climb. It was a vertical acceleration. Now imagine standing in early 1979 and predicting that move. Most people would have dismissed it as fantasy. But silver's nature is explosive when supply-demand imbalances tighten and momentum feeds on itself. This is why today's structure deserves attention. If we take the current breakout cluster as a starting signal and we assume, just for analysis, that we are entering a final acceleration phase similar in percentage scale to 1979, the math becomes eye-opening. Even if we do not repeat the full 700% move, even half of that would represent a dramatic revaluation of silver from current levels. Of course, history does not guarantee repetition, but it provides boundaries of possibility. And silver's past shows that extreme moves are not unprecedented. Now let's address the argument that the bull market could be nearly over. Some observers point out that in the 1970s, clusters of consecutive weekly all-time highs occurred within relatively short time spans. The final wave came quickly and ended quickly. So if we apply that pattern mechanically, one could argue that after the first new cluster appears, there might be roughly 1 year left before a major top forms. It is important to consider that possibility honestly. If that scenario plays out, the next 12 months could be the most volatile and powerful period of the entire cycle. That would mean rapid gains, strong momentum, and increasing media attention. But it would also mean sharp pullbacks and emotional swings along the way. Silver never moves in a straight line. Even during the explosive 1979 phase, there were violent corrections inside the uptrend. Investors who lacked conviction were shaken out repeatedly. However, there is another perspective that may be even more compelling. Unlike 1979, today's silver market operates within a completely different macroeconomic environment. Global debt levels are dramatically higher. Monetary expansion policies have been used repeatedly over the past decades. Industrial demand for silver is stronger and more diversified, especially with growth in renewable energy, electronics, and advanced technology applications. Silver is not only a monetary metal, it is also a critical industrial input. That dual demand creates a unique dynamic. When investment demand rises at the same time, industrial consumption remains strong, supply pressure intensifies quickly. In the 1970s, monetary instability drove silver's surge. Today, we have both monetary instability and structural industrial demand. That combination did not exist at the same scale decades ago. So while the historical 8x move in 1 year sounds extreme, the modern environment may support sustained strength over a longer horizon rather than a short blow-off top. Another key difference is awareness. In the late 1970s, information spread slowly. Today, financial news, charts, and social media amplify momentum rapidly. If silver captures mainstream attention again, participation could accelerate much faster than before. That creates two possible paths. Path 1. A fast, dramatic spike over 1 to 2 years followed by a deep correction. Path 2. A strong but extended multi-year uptrend with several acceleration waves rather than one single vertical move. When we study the current weekly all-time high clusters, what stands out is that we are still in the early stage of the new sequence. Historically, clusters in the 1970s tended to get longer and steeper as the cycle progressed. The first cluster was modest. The next was stronger. The final ones were explosive. Right now, we have seen an initial cluster of consecutive weekly all-time highs. The percentage gain during this cluster is impressive, but not yet historically extreme. That suggests we may not have reached the final acceleration phase yet. It feels more like ignition than exhaustion. And remember something very important. Silver spent over 40 years without producing sustained new weekly all-time highs. That long dormancy builds energy. When an asset trades sideways for decades relative to its previous peak and then breaks out structurally, the release can be powerful. Markets move from accumulation to breakout to acceleration to climax. Based on the structural data we are observing, silver appears to be somewhere between breakout and early acceleration, not climax. Of course, discipline matters. No investor should assume guaranteed outcomes. Risk management always comes first. But dismissing silver's current move as already over ignores the historical evidence of how this metal behaves during true bull markets. If silver is following even a partial version of its historical pattern, then what we have seen so far could be just the opening chapter. And that is why long-term positioning, patience, and perspective become critical at this stage of the cycle. Now let's step back and look at this entire situation with calm logic and long-term perspective. Silver has a personality. It sleeps for years. It moves slowly. It tests the patience of investors. And then suddenly, when most people lose interest, it wakes up. And when it wakes up, it does not move gently. It moves violently. What we are seeing right now does not look like exhaustion. It looks like transition. For more than 4 decades, silver failed to create sustained weekly all-time highs. Even during the 2011 rally, it did not build a structural cluster of fresh highs the way it did in the 1970s. That matters, because clusters of consecutive weekly all-time highs are not random events. They are signs of strong underlying demand pushing through historical resistance levels again and again. And now, after decades of dormancy, we are finally seeing new clusters forming. That is not normal behavior for a market that is finished. That is behavior consistent with early-stage structural breakout. Now, could there be pullbacks? Absolutely. Silver is famous for sharp corrections. It can drop 20% or even 30% during strong bull phases and still continue higher later. Volatility is part of its DNA. But volatility inside an uptrend is very different from structural topping behavior. A true long-term top usually forms after widespread euphoria, massive retail participation, extreme media coverage, and speculative mania. Right now, we are not there. Most mainstream investors still hold little or no silver exposure. Large institutions are still underweight precious metals compared to equities and bonds. Retail participation is growing, but it is nowhere near historical frenzy levels. That tells us something important. If silver were truly at the end of its cycle, we would expect to see universal excitement and overexposure. Instead, we still see skepticism. We still hear people saying, "This move is over." Historically, major tops do not form in environments filled with doubt. They form in environments filled with certainty and greed. Now let's revisit the extreme scenario for a moment. In 1979, silver went nearly 8x in 12 months. That sounds unbelievable. But it happened. If someone had predicted that in early 1979, they would have been laughed at. Yet history recorded it as fact. Today, projecting large percentage gains sounds equally unrealistic to many people. But markets do not care about comfort levels. They respond to supply, demand, liquidity, and psychology. We are living in a world with record levels of sovereign debt, repeated monetary expansion, persistent inflation concerns, and growing industrial demand for silver. Renewable energy systems require silver. Electronics require silver. Advanced technologies require silver. Investment demand sits on top of that industrial base. This combination creates tight supply conditions if investment demand accelerates strongly. Could silver go dramatically higher from here? Yes, it is possible. Will it follow the exact same mathematical pattern as 1979? Not necessarily. Markets evolve, conditions change. But the scale of historical moves reminds us not to underestimate silver's potential. At the same time, patience is essential. Whether this bull market lasts 1 more year or 5 more years, emotional reactions will destroy more portfolios than price volatility ever will. The investors who benefit most from silver cycles are the ones who stay disciplined, think long-term, and understand the metal's historical behavior. This is not about chasing hype. It is about recognizing structural shifts. Fresh clusters of weekly all-time highs after decades of absence suggest we are not at the end. They suggest that something bigger may be unfolding. Silver has not even started its true acceleration phase if history is any guide. And that is why this moment matters. If you want clear, rational, and data-driven analysis about gold and silver without noise or distraction, make sure you stay connected with Gold Silver Scope. This channel is focused on helping you understand the deeper trends shaping precious metals so you can think independently and prepare wisely for what comes next. And finally, a short disclaimer. This content is for educational and informational purposes only. It is not financial advice. Always do your own research and consider your personal financial situation before making any investment decisions. The silver story is not about fear. It is about cycles, structure, and opportunity. And if history teaches us anything, it is that when silver truly moves, it moves far beyond what most people think is possible.